day, everybody. It's Greg Schnell. I'm here with the market roundup for April 27th, 2019. Big week, really big week out there. Lots of good things happened. We got a lot to go through, so I'm going to shoot on right now. U.S. markets still look good, making new highs, not a lot of distribution, so that's all good. I will say the industrials chart is trying to break through triple top, so that's kind of interesting. We'll watch that. Weak rally, though, considering the tech stocks all had big earnings. So we're going to get into that, and I'll show you what I mean there. The Fed meets to start May, so we got a Fed meeting coming up this week, and that might cause some disruption. So we'll just be aware of that. And the U.S. markets, again, hit all-time highs, which you're always in a bull market when you're hitting all-time highs. So that's good. Canada made new highs last week and then was flat on this week. So we didn't have any real change from last week's close. Literally closed at 0.00%. So that's no big deal. But China had a huge down candle this week. And we'll just see if that's more of the same. But basically made an outside reversal for the last 4 weeks. So that's pretty bearish. And the U.S. dollar soars and closed, at multi-year highs, and commodities have a huge down week. So we're going to jump into all of that today. The one thing I didn't put on this chart, somehow I forgot, was bonds, and we're going to start on bonds. So let's go there. And there's a reason I want to start on bonds, and that is that they haven't gone the way I would have expected them to, based on all of the good news this week. So one of the things, this chart here is the 10-year minus the 2-year, and you can see these big major downtrends. And this downtrend happened to bottom in 2000, and again there was a break in 1998, which was the Asian financial crisis, and we had long-term capital management in there, so that was a big one. But we also see in 2007 here we had this big pullback, and kind of when you saw the breakout of the 10-year going the other way, that wasn't a bad clue. And again, right at the bottom, that wasn't the signal. The signal was more that it had turned into an uptrend. And in this case, in 2006, they had an early shock warning. In 2000, they didn't really get one of those. Basically, the retest of the low was the actual top of the stock market for all the other indexes. That they went back and tested their March highs on this retest and then took off to the upside. So here we are testing the December lows in terms of this spread, and now we've kind of pushed to the upside. And so one of the things I'm interested in, and again, I'm looking for warnings, not solutions, but this trend line I had drawn a couple of weeks ago, and you can see we've now broken this, and this is an 18-month trend line or 16-month trend line. The big issue for us, I guess looking in hindsight, that's 14 months, Greg, but the big issue for us is it's starting to break out. So that just says a little more caution on the table, doesn't say sell everything. This is the one that I'm more interested in, and this is the yield curve. And what we saw is in the month of March, they all started to rally. They've been going down basically since, here was the end of September. That was kind of a major top. And you can see all of them started to make sideways moves and then down lower since then. And the real issue for me is the 10-year had made a new 52-week low. And so what I want to watch for on there is which way this wants to break. Now, this 3-month here is quite indicative here. It's gone sideways for 4 or 5 months now. If this starts to roll over, I actually expect more trouble there, and I'll show you why on some of the other charts. So I want to just keep watching these bonds, but they're starting to, again, here we have the 3-month and the 10-year crossed. But more interesting is that the spread between the 10-year and this is the 3-month and the 10-year cross. The brown line is the 10-year, is the spread distance between these two. And so what we want to see here as we go forward is that this actually narrows, not widens out. So what would happen is the 10-year would fall faster than the 3-year, and that's kind of one of the signs we see in the market during a big rollover. So this is all squeezed down, and I've got another chart, I think, with that expanded out, if I'm not mistaken. Let's just see. Maybe one more. No. Okay, so let me just, so the point I want to make is on this spread. Here is as these widen out, this becomes an issue. And if we look at the chart here, this chart is going back to 2011, and you can see this big downtrend line of the ratio between the 30-year and the 10-year. And if this was to break to the upside, that would be a big deal. So you can see that here in October, when we kind of broke this small multi-year downtrend, that was when our correction started. And now the real question would be for me is, are we going to break this big trend line? And if that was going to happen, that I think would be important. So you can see back in 2015, as this started to accelerate higher, that was a problem. And here in 2018, that was a problem. So I think this is a worthy chart to keep looking at. But I think the bigger issue, obviously, if you're looking for a major market breakdown, would be to break this big giant trend. And so what we see is that this has started to reaccelerate this week higher. And again, nothing major yet, but interesting with all of the good news out. You know, we had the GDP number on Friday, right? That was all good. But what happened here was the market actually, the bond market went, prices went up and yields went down, which says people moving towards safety, not away. And so just zooming in here, the bigger issue for us, these are some of the stock markets below the S&P, the DAX, and the Nikkei. And when these trends broke out, these were interesting places to be aware of in terms of the stock market starting to go lower. And that, again, that's what I'm watching for. So we're right on this trend line, sitting just a little bit below it. Obviously, this is a zoomed out view, 50,000 foot view, not really detailed. But if we were to start to break out through this 0.4 level, getting onto 0.5, that would probably be the issue. And here we are at 0.45. So it's at least worth watching as we go forward. Actually, in the Zoom panel here, it says 0.41. But I think you get the idea that we're close to that. So it's one of the things that I think is worthy of watching now. On this chart here, I've got a few others that are more interesting. And again, I think the bond market, just because of the leverage, is a good place to pay attention to, because they typically would smell out problems before the equity markets. So the junk bond market actually had an up week this week and made higher highs, so that's bullish. The 10-year actually bounced off the 10-week moving average and went higher this week. And you can see that it's in a trend of rising highs and lows and trying to get back through this kind of, I'll call it linear regression or the average of the last few years, but it's also a major support and resistance, it seems. So what I'm wondering here is just which way this wants to go, and I really don't have a feel for it. And in the background, I've hidden the junk bond market, is this shaded gray. But we're actually breaking out to the top side now. I don't know if this just rolls over again or what we get here. So when I compare the junk bond market to the 10-year or the 7 to 10-year ETF, what you see here is this is making lower highs and it's right around its 40-week moving average. Looking back in 2015 as the market topped out, we saw the same thing with both the junk bond having a lower high in place and making a lower high compared to 2017. It's actually right in line here, trying to break through this 2018 previous levels, and it has broken out a little bit. So it's right at that level to watch. But interesting, as the junk bond market went up, the actual 7 to 10-year went up faster, and that would suggest just starting to change direction. And you can see that the momentum on this black line is near zero, and this was the same kind of thing we saw back in 2015. So while we're here, it's at least a place worthy of note, just that momentum might fail here, and we should be a little bit cautious. Just watching how that performs over the next couple of weeks. And again, what drew me to this was with all of the good news and the GDP good news and the big earnings out of the tech companies, why all of a sudden was there a push into the bonds? And so I think that's just worthy of watching. And so here we have the corporate bond market, and it's breaking out to higher highs above this trend line, which surprises me quite a bit, actually. The 2-year has rolled over. And again, the three big market rollovers that we've had in the last 20 years. 2000, it was a major rollover, and as the 2 year rolled over and the RSI came off overbought, we saw this big move down, and that was actually where the stock market started to decline. They don't line up exactly, as you'll notice. This is spring, this is summer, and this is fall. So in this particular case, they lined up pretty close with the momentum rolling over as the RSI let go. It went below our moving average here, and then it took a while, another whole year, for the stock market to top. Moving out to 2016, we had this drop here in the monthly, and 2016 rolled over from quite a big move in the market, and this doesn't look like much, but it was pretty significant at the time. And we saw the RSI touch 70 and pull back. Now we've got the same situation from a very overbought RSI. It seems to be working its way down. And again, if we, maybe perhaps it's when it actually crosses this 50 line, maybe that's what we need to watch a little bit more for. But we're, as you can see, at 56. And so we'll just keep watching this. But that's a monthly chart. And then looking in, I've got a 2 year, for some reason I got these out of order now. Let's go down to the other 2 year charts. And you can see that this trend line, I've put kind of I'll call it the main trend line here in 2016, midsummer 2016, this broke below. But you can see that we've kind of rolled off the top here, right at that 3% interest rate level, which was kind of critical in history. And we've rolled down, and our PPO is right at zero and is starting to roll over again. And so it's this rollover below zero that starts to bring it to attention to me, especially, considering what I would have expected is a bounce off this line, and we're starting to get the exact opposite response. So it just makes me trying to be more aware of the bond market, because I think it's throwing off a lot of clues. So this is the 2 year Treasury yield, and again, this topped out pretty much while the stock market topped out, broke a PPO trend line here, and broke down through it, and we're still in negative territory, so this doesn't look ready to rebound yet. And you can see this week it's actually starting to reaccelerate down. So with the Fed meeting next week, that's pretty interesting. Now this is the daily chart of the 3-month yield, and if we just switch it to weekly, it smooths it out quite a bit. But the point I would make is we do not want to start to see this roll over and make new fresh lows here. I think that would probably be a problem, and if that was to start to transpire, I think that would actually speed up the bond market quite a bit. Okay, so some of the other charts that changed this week. This is the 5 year, and I'm just gonna hide the bank index from behind it, just because it kind of confuses it. But you can see that we keep bouncing off this 10-week or 50-day moving average line and dropping down here. And it's this kind of break of the upward trend that I think is starting to show up on all these bond charts. And then after we break, the fact that we're having trouble getting back up there to re-rally, in spite of the good news in the stock market, really suggests to me more issues to be worked out. So from that perspective, I think it's important just to be aware that all of these are starting to roll over. Now I've got the other chart I was trying to find in here. And it's this chart here that what you see so this is 2007, and what you see here is when the stock market, or when the other bond yields really started to fall and the 30-year stayed up quite high, it just didn't fall as fast. But it was also one clue that things were changing quite quickly. And so as these other bond yields really started to implode, and the 30-year was not moving down as fast, that was kind of one of the clues. So keeping track of that spread is important, and that's what this chart that we were at here, keeping track of the distance between the 30-year and the 10-year. And I would say if this started to break through this 8-year trend line, there's probably some clues for us that there's bigger issues out there. Okay, so, and again, just looking at this chart, what we saw is during most of the major recessions, we saw this phenomena happen multiple times. So it's at least worthy of note. And so far, this week it's starting to speed up. So just again, another reason to be aware of the issues out there. And this is that chart, just with some different signatures on it. And I think that more importantly here is the PPO is just coming down to zero. And if this starts to bounce up, or in this case the MACD, if this starts to bounce up, that's probably a meaningful clue that it wants to stay above zero. And that's the kind of thing that started off in '07 and 2001, 2000 period. So anyway, worth watching. Just notice this directional change. So we rose off the lows, came up, pulled back, and then late last week we started to move back up again. And so we have this higher high in place. The real question is, are we going to start to keep going past that? And I think if the bond market does that, that would be a bigger clue. Okay, here's a look at the commodities for the week. And, marijuana stocks actually are starting to look quite good. And so I'd like to point your attention that way. Natural gas made a new 3-year low or 2.5-year low about 2 weeks ago. And that was down in the 240 something area. And now it's trying to bounce out of that. So it's very early, but I would say it was below support and moving back above 250 suggests it might be coming back into range. So that chart's quite interesting from a trading perspective. And again, you can't really trade natural gas based on fundamentals because it's pretty wobbly. But if we just put a line in here at 250, you could just see, so 250 was slightly below the prior support. I guess 253 would be a little better. And we broke down into the 240s, and now we're starting to bounce up. Now the real question is, in this one it was a nice bounce. This one it was a staggered bounce, took a while to get going. So it's not a great trade just necessarily because it's come down to a new low. What I like about it is it's retesting the prior low from earlier in the year. And if that was to start to accelerate, that could lead into something pretty good for us. And here, if we go back into the April timeframe back here, this was the start of a nice run in 2016. 2017, it was the opposite. 2018, it was the start of a pretty good move. Doesn't look like much, but $2.50 to $3 is about a 20% improvement. Anyway, so those are some of the things that make the commodities interesting, but rare earth metals, lithium, steel, nickel, Canadian crude, aluminum, copper's in here too. All of them pulled down quite hard, and again, copper was up around 3% or $3 not too long ago, a couple weeks. And it's already down 3% off those highs. So just, not quite what we'd expect if we're entering this big global bull market. And here's West Texas crude. It fell $1 or 1% on the week, but it's down a couple of dollars. And so the main concern, actually not on the week, but its previous high had been $66, $67 up there. And this pullback now seems to be starting to get speed going on it. So I'm very cautious on those. And gold miners are trying to get going this week, but they were basically flat. Silver and silver miners tried to do a little bit better. And gold obviously did better, but the gold miners, a little slow on the uptake. So far, I think the only two interesting commodities this week are the top two here, marijuana and natural gas. And these other ones that are kind of China dependent really don't look that good. And part of that could just be the China chart, and I'll just put it up now so I stop the suspense on that. I'm going to zoom into the final year here. And what you see is this big all-encompassing bar that took us down below support and after this big push up, we've struggled to go any higher. Last week closed near the highs, and then this week to drop right back down. And you can see this is the closest we've been to the 10-week moving average in a while. So new 1-month lows, it's definitely a place to watch if this is going to continue to roll over. Usually this is kind of how they start. You can see back in here with that same sort of reversal, and it fell down. So just be aware that China's starting to, that chart's been wobbly for a little bit, but we're back in the range that we were at mid-March, and it wouldn't take much to, another week like that, and we'd be back at 2.5-month lows or something like that. Okay, so I've covered off the bonds as much as I can, but all that to say, with good news, the bonds didn't really go the way any of us expected, or the way I expected for sure, and guys like Santelli on TV had mentioned the same sorts of thing. So I'm watching those charts more closely, but getting into the commodities, let's just roll through them quickly. Oil, it's not down a lot. This was its weekly closing high, but it had intraday highs up. I think we got all the way to 67. We can just change the chart here and check that out. And 66 and a half, 66. The high for the week was 66.60. So it's this outside reversal that we see on crude that I'm a little bit worried about. We'll find out if it's right to worry or not, but it also comes in right at this horizontal resistance level from the previous high. So just an important place to be aware of. And natural gas, again, this is the dip below and trying to bounce back up. Heating oil, rolled over, but nothing major, still above the 10 weeks. So these energy ones, oil, gasoline, and heating oil are still above their 10-week moving averages, so they're okay. Here's corn, soybean, and wheat. And what we see is all of these are breaking down again. Like they literally look like they were going to start to get going here a little while ago and then have just rolled back over. Gold and silver, let me just go back and check one thing there. Yeah, okay. Gold and silver, again, trying to bounce a little bit, but gold's clearly below support. Silver, the bounce doesn't even look as significant. Lots of work to do there. Copper keeps rolling over under this $3 level and is now below its 10-week. So that's usually not bullish for commodities. And aluminum continues to let go. Livestock, sudden reversal and new 2-month lows there are below its 10 weeks, so that's a bit harsh of a reversal. And sugar and coffee, again, below its 10-week, and coffee's always below its 10-week, it seems. Looking in on cocoa and cotton, a rollover on cocoa and a rollover on cotton, but both are at least above their 10-week moving averages. Medical marijuana started to turn up this week. And I don't know if we'll get time to cover it, but the charts actually look quite positive in that area. So I would encourage you to go look in there. Stocks like Canopy Growth look like they're ready to break out and make a big new push higher. And just to remind you, those names like Canopy Growth, their market cap's $23 billion. So these are getting to be pretty big companies, and I just compared them to all the utilities in Canada, and they were larger than any Canadian utility, any publicly traded Canadian utility. So that just gives you an idea that these things are really starting to attract a lot of capital and are worth following. And again, with this pickup here, it's not too specific, but just kind of want to own them above the 10-week and not when they're below the 10-week. And each chart, obviously, there's a whole bunch of different players in here, but the big ones, if this is quite a reversal on this chart and starting to take off, bouncing off the 40-week moving average, this looks really nice. And if the full stochastic is going to start to turn up here, that's pretty bullish. So at least there might be something to trade there on the positive side. Coal is barely above its 10-week moving average, but just about it hooked down a little bit this week. But still, you can see it moved down hard after breaking above resistance and seems to be breaking the other way, not quite at new 3-month lows, but very close. Lithium, the breakout that fails again. And on the rare earth metals, same thing, breakout that fails again, and now back below this trend line. So it just keeps working us sideways. But these breakdowns here, 3-4 month rally and starting to break down, that's kind of bear market stuff. So we'll just keep watching, but not all that optimistic on that stuff there. Getting into XLE, what we see here on the energy sector is this huge breakdown from this wedge, and all of a sudden we're stuck right here on the 50-day moving average, closed literally right on it. But the momentum has been flat while we've been rising here, and you can just see how things are narrowing in and then all of a sudden start to drop out. So this is called a bearish wedge because it's working its way higher, but they're getting closer and closer. The tops and lows are getting closer together, and then when it finally breaks, it actually breaks quite significantly and goes down quite hard. So we'll see if that's the case, but it looks to be that to me. And here's the oil refiners, and they've been grinding sideways for 4 months. PPO is still below zero, so this is very cautionary. If this is going to start to roll over and accelerate, that would be a big deal. And we're right at the 50 level. Don't usually want to see this chart get below 50. It did back here in 2018 multiple times, just came down and touched it, but when it actually fell through it, that was pretty important. So here we sit right on that trend line. We're still below the 40-week and just fell below the 10-week this week, so not a lot of good news on that chart. Frac, the weekly, so this is unconventional oil producers, and you can see the full stochastic has rolled over, which is no big deal, but we're rolling over at the 40-week moving average. Typically the kind of things we'd see in a bear market, so right in 2015, and this was as the stock market topped and down it went. And we're below zero here, so if this is going to roll over again, this could be the redo of the movie from 2015. And as this rolls over, just a big place to be extra cautious. This is frac on a daily basis, so after this nice big breakout here, spent 2 weeks trying to do something and lost it all in a couple of days. So the chart doesn't look very, very bullish yet. West Texas crude, getting into, here's our 66.60 high. Nice round number, 66.66 back here, so very similar. And we'll see if this is just a little drop on the way up. We're a lot closer to our 40-week moving average or 200-day moving average here, and it's down sloping. In this particular case, we were up sloping, overbought, pulled back, and then kept going. So what worries me a little bit more here is that we're so close to our 50 and 200-day moving averages that if this was going to start to fall, this is probably an important level here, this 60-61 level. Looking in on crude yearly, I think the big thing to see is we're kind of above the highs of the last 4 or 5 years, with the exception of 2018. So, we're starting to break out of this range that we've been in. The real question is, does this become another, tall wick on a candle here and we end up pulling back down? But there's a lot of price action down in this lower level around $55 where we start and stopped a couple of years, and it's kind of been the middle of some of these bars. So anyway, let's keep our eyes open, but 66 seems a little bit high. I think we get a pullback into this 55 level, and then we'll see where we're going. That's just my interpretation. XOP is above its 50-day moving average, but again, moved down pretty hard on the news this week. And this is after we had the mergers in the industry. So we had Chevron make an offer for Anadarko, and then we had Occidental come back with a $9 higher price, so they were at 67. It went to 76 for Occidental's bid, and yet even with the enhanced move with mergers and acquisitions kind of stuff going on, the market still fell apart on these exploration and production companies and made new 3-week lows in a couple of days. So Still not great, and we're seeing this divergence on the price of crude as it was making higher highs, it was making lower highs in momentum. So we'll just continue to watch here, but I think we're going to see crude move back a little bit, and the full stochastic has fallen below our 80 level for quick traders. Okay, USO, again, just the ETF that's easier to trade. And here we've got this upward sloping trend line and now breaking in this level. And look at the candle for Friday. Crazy just how fast that moved down. Nat gas we've already talked about, so I'll just keep rolling here. Again, the real question is, can it get back above? And if it's going to jump back up here, this is a nice rally to be part of. One of the things about commodities, when they trade at extreme lows, they can move up quite quickly. We'll see if that becomes the case as we enter air conditioning season in the US. The FCG natural gas ETF is actually right on the 10-week moving average. A lot of these companies in here also have a lot of oil, so if oil moves quickly, they might move quickly. Here's Cabot Oil and Gas, and you can see it pushed up on the news of natural gas starting to push higher, so that's a little bit better. And the ratio for the natural gas companies compared to natural gas is still improving, but last week it pulled down quite hard. Okay, no real news there. And this is nuclear. And what's happened to nuclear is it's trying to bounce. These are the nuclear utilities or power plants trying to bounce off the 200-day moving average. Getting into the actual uranium miners in the URA, this chart's been pulling back for a couple of weeks and a failed breakout again above the trend line here. It's still making a higher low so far, a little bit higher. PPO is coming down to this trend line. Cameco actually had a terrible week. Let's just put up the Cameco chart. This is the Canadian version, but you can see it broke down and is trying to hold above the 40-week moving average, but that goes back to new 3-month lows here if this doesn't hold. So not that bullish that this is going to get going yet. Okay, and this is the big picture for the ETF. And what we see here is that brief breakout now pull back, and we're trying to hold at this support level around $12. We're rolling over right below zero, and we'll find out if there's any horsepower there at all, but it's been a pretty dead trade for a long time. Here's copper. What we see on copper is a big move off the September lows in momentum here, but we traveled sideways. We briefly had a couple of weeks where we went up, and then we went sideways for months now. And the real point is, if we start to lose 283, I think we could see copper drop quite quickly, because that's a little bit of a support area. So we'll have to keep watching just to see how that works out. But again, with that move down in the Shanghai, we might find that copper starts to duplicate that pattern. Okay, and this is bigger picture, just copper 5 years. You can see on this support and resistance level at $3 how important it is. We got up there late last week or early last week and then pulled back down. The fact that we've gone nowhere in 8 weeks is probably more meaningful than the fact that we tested the $3. There just doesn't seem to be any momentum yet in copper. Okay, steel, the ETF, again, rolling over below its 10-week and 40-week. That's pretty bearish and rolling over right at zero. Nobody's coming in to buy this thing yet. So that's the other thing that adds caution to me, is nobody seems to want to own it. Aluminum has fallen down here and has made new 2-year lows. So that's quite bearish, obviously not really great. And looking at the metals for last week, the XME metals ETF, this is starting to very close to new 3-month lows here. So be cautious. If this continues to fall away, it could start to accelerate. Canadian market rebounded a little bit with gold on Friday, the Canadian metals index or materials index. And we're just not seeing great price action out of the group. But again, one of the things I'll get into right away here with gold is if it was going to start to turn up, this is where we'd expect it. And the reason I say that is the momentum has gone above zero. What we want to watch for is these bounces off zero levels like we had back in December 2017. This was a really nice push up after pulling back and kind of talking people out of it. off it went to the upside. So that was quite a nice place on the weekly charts to watch for. Our full stochastic is right down around 20, so a turn up here would be a nice buy signal, and we've had a couple of those in the past. So important week to watch gold. Looking in on the daily chart, this was the move, so we made a new, whatever, 7-day high or something on gold. Not that great, but I do like the fact that this PPO is starting to finally turn up here in a little bit more thrust, and it should take off, if even for a short trade. Okay, GLD, no real news here. I just want to go on to GDX ratio. So this is the GDX GLD ratio, and normally when this trends higher, that's positive for gold. You can see we're not trending higher and we broke the uptrend. So we might need this to base a little bit more and give us a chance to build a trend line, because we've seen this movie before and all of a sudden down it goes, and that was part of gold falling away. And this 21 level is pretty important on the chart. We'll see if it can hold up for GDX itself. But again, the big issue is it seems like the gold miners are underperforming gold again, and that's not usually bullish. With a rising US dollar, that's not a surprise either. So we still don't have gold starting to outperform the S&P, and that's probably the next ingredient required to actually get money moving in, is that gold would start to outperform on a relative basis. Nothing really to cover off there, so I'm just going to scroll down, hit the lumber stocks, end up doing that quite a bit. So here's the lumber move, and we saw a big push up, and then this week we saw a really nice reversal bar where we opened lower, tested lower, got down near the prior lows, took off, and had the highest close, or closed above the previous 2 weeks. So quite nice. We'll see if this is going to make a higher low right here. This would be a nice place to enter lumber. So, and then we could just go grab this other chart, maybe over here, and get wood, the lumber ETF. And again, just below its 40-week moving average, we need to see that start to surge. And if that was going to start to happen, you probably want to get on board. Okay. This chart here, let's go back. So some of the other things to point out, Ford had a fantastic week. Really a nice push here after earnings, and broke above this major downward trend line and horizontal resistance, both in the same week. So really nice big push, lots of volume accompanying it going back 6 months. So big push there, and the scooter ranking got up to new 5-year highs, so that's crazy good. The other car makers, there wasn't a whole bunch going on. I was starting to get intrigued with some of these bigger car part companies like Magna, but they seem to be rolling over here just as momentum gets barely above zero. So hard to want to buy it right here. I know it looks okay. It just doesn't look strong, and that's probably the bigger issue to me. And then Tesla had a terrible week as it broke to new 2-year lows. And this 2-year lows on Tesla, I think, is critical if we widen out the chart. And what we see here is, Tesla was range bound for years. In this period here in early 2016, when the overall market was falling, Tesla broke down and then was able to re-accelerate with the market. In this particular case, Tesla's breaking down and the market's hitting new highs, so it doesn't look very strong to me. And again, the relative strength is starting to break down to new multi-year lows. So I would be much more cautious on Tesla here for the Tesla bulls, and I'm starting to use the name Tesla for it because they said they were going to have 1 million unmanned cars on the road next year, and it just, based on their production levels, that would be pretty much impossible. So anyway, here's Tata Motors rolling over and sitting right above $15. This has had a nice surge, obviously, from 13 up to 17, so a good 20% move here in 4 weeks. Give it a little bit of room to wobble and see if it can keep going, but nice move so far, and good if you're trying to get into it. A pullback, it would be necessary. Okay, Europe. Europe had some nice pushes here. We're closing in on the end of the month, and you can see that we've really, Germany's gone up every week so far since the start of the month, so that's really bullish. And the French market, I've got monthly and weekly. The French market is trying to break through to new prior highs, not all-time highs. We can see that on the previous chart. All-time highs back in 07 and 2000 were higher. We're trying to break through this 2017, 2018 sideways consolidation. Okay, let's go. The one thing that I'm surprised at, I like to watch the Amsterdam market just because it's a little smaller. And it actually had a down week as we tested the prior high, so couldn't quite push up and take it out. Another market I like to look at is the Swedish market. I think I mentioned that before. And this one looks very bullish. It just shot up this week and suggests that maybe there's more highs to go for some of these European markets. The Shanghai I've already shown you, but here's the Hang Seng. It wasn't as weak as the Shanghai, but it did make new 3-week lows and close near the lows. And this would be kind of an exhaustion gap, runs up and then falls away. So we'll just see if that's what it ends up being. But right now, that isn't a good configuration that we've seen so far. It's not terrible yet. It's okay for the market to pause. I think the big issue was that huge outside week in the Shanghai was quite concerning. The Nikkei on the weekly basis really didn't do anything. Let's just jump in here, and you can see we were marginally below we opened slightly down, tested lower, but made a higher low and a lower high. So we call that an inside bar. And we did close higher than the previous week, and we closed high at the high of the week. So that's usually bullish. We're barely above the 40-week moving average, but we're trying. And again, my big line in the sand for the Nikkei is if it starts to fall below 21,000, all bets are off. Okay, Australia, nice push this week, really a big push. Couldn't quite take out the prior high here, but very, very close to it. And that is a huge move and closed right on the high, so quite bullish there, even though all the commodities pulled back. So Canadian market, we were flat on the week. You can see 0.00 and big doji after last week's push to new highs. So we'll see if there's anything going on there over the next week. And here's Brazil trying to bounce off this uptrend line, and as long as that works, that's bullish. The fact that the commodities pulled back so hard, I'm surprised it had such a good week. So we'll just see if that ends up sliding. Here's Russia, and it had been looking pretty good. It didn't do much this week. It made an outside bar with a higher high and a lower low and closed near the lows. So we'll just see if that ends up being a reversal bar, but typically that's the kind of thing we would look for. Okay, looking in on the S&P for the week. You can see this push to the 1 hour bar on Friday was just straight up to try and get this close above the prior high. So 29.39. Let's just turn on our price labels here. Price labels puts these little boxes right on top. So we needed 29.40.91. I actually thought we did. What was our intra high? 29.39. No, so we did not make it to take out the prior high. I guess that's next week's job. On the SPY, which has the dividends included, we did make it to new highs. And here's the NASDAQ, and this did push to new highs. And again, I'm a little bit concerned about that, and maybe we'll flip over to that right now. There's nothing really else interesting in here. It's always good to watch the India market. It's been consolidating for 4 weeks. It's not a problem, but it hasn't been able to push through decisively to new highs yet. And it's kind of right at this downtrend line in momentum, so we'll see if it's got any more gas in the tank. Okay, let's jump over and look. This is the U.S. sector ETFs for the week, and here's communication services, but here's discretionary, down slightly. This is relative to the S&P, and this is absolute. So up slightly on the week. Communication services had a really big week, but technology itself was one of the lower performers this week, and you can see the defensive area starting to actually perk up a little higher than this area. And we saw industrials, material, and energy, and this was on the back of 3M was a weak number. We had a couple other companies in there, but these are pretty weak. And so what we'd be wondering about is all of a sudden these ones look a lot better. This is over the last week again, but showing the defense side starting to show up, and it might be marijuana names on the healthcare, but probably other ones, bigger names in the US that would have had to take off in order to get that size of a bar. That was a big bounce off a 3-year trend line for XLV. That chart's still here, yeah. So here's the XLV trend line, and we were trying to bounce off that, so we'll see if there's any more room to run here. To me, this chart has a lot of bullish and bearish characteristics, like evenly matched. I would just say that if you wanted to place a trade, you've got to stop nice and close. If the momentum continues to go below zero, I would be out, but if this thing can turn right here, so close to the trend line, that's a great place to get on board. So it was quite a balance there on that one. Let me go get a couple of other groups. I just want to show you the Canadian groups, and the reason is I think the Canadian market will start to stall before the US market. So just on absolute value here, Infotech, Shopify is in Canada on this list, so that holds up quite well. This is 200 days. Let's go get a past week. But what you see here is healthcare. This is the marijuana names really starting to surge. Energy quite weak. Nothing else really going on with the exception of the railroads, and the industrials held up okay. But, financials were down on the weeks. Utilities were down on the week. Consumer staples down. So it wasn't that good with the exception of marijuana. They really started to move. And so one of the places that I think might have a little bit more upside for us. Okay, let's jump up here and just briefly look. I've covered off the breadth indicators on Market Buzz on Friday. There's not a lot of change. I would just say, the advanced decline line for the NASDAQ is sitting on its line. Here we'll see if it's going to break out which way. That's one of the questions right now. And the only thing that I wondered about was the NASDAQ wasn't doing a whole bunch with all of these great companies reporting pretty good numbers, or real good numbers. The New York advanced decline line didn't really get going either, and you can just see it's kind of on a declining pitch here, so we'll find out if there's more. But we're struggling to get through this prior high in September. Been jogging sideways for almost the whole month on the overall composite. Briefly, the high-low for, as the market pushes to new highs, yet we only had 91 stocks making a new high. So we're stuck in this lower range, and that's just very frustrating because I'd like to see that start to break out if we were going to have a big, broad bull market. Let's go down into options expiration. Obviously, that was last week on this red line here. And continuing to hold this uptrend. Look at how far the NASDAQ uptrend is away based on this one little low here. So I could run it up this way and be a little higher. But, the slope back last year was kind of similar as we broke down in September. So I've left it this way. I'm not sure I want to watch it fall 300 or 500 points to get back to the trend line. The Fed. So we have a Fed meeting Monday, Tuesday, might be Tuesday, Wednesday, I think it is. And then off the back of that Fed meeting, as we're trying to break through the highs, it would be kind of critical. And you can see back in September, that's exactly what we were trying to do, break. We got up to this level, and then the Fed meeting, and down we went. And so here we sit up near the top, and as we approach the Fed meeting, it's pretty important. I will say, before that Fed meeting, we had only one, and this was an options expiration in here, quadruple witching. We only had one distribution day, and obviously the market started to fall after that, and we ended up with one on the backside of the Fed meeting. But within a week, that's when things started to unload. So my point would be, don't think we know what's going on with the Fed yet. That marked a real change in market tone there. Monthly performance for the S&P 500 up nicely, up almost 5% this month, which is crazy good. And then year-to-date performance continues to be outstanding, 17%. It's going to be difficult to imagine that that's going to continue for another 9 months or 8 months. So weekly outside bars, this is just one where I compare the three indexes. So both the NASDAQ and the S&P had nice pushes higher. The Russell not so much. Well, on a daily chart, it looks like it had a pretty nice day. Again, we're just continuing to be stuck in this sort of resistance area. And while it closed on the highs is the good news, it didn't really make anything new go on. The NYA is an interesting market to keep track of. And one of the reasons I say that is, it was kind of what tried to break out to new highs but failed back in 2015 and then rolled over. And so here we're right at this trend line. It hasn't broken out yet, or it's broken the trend line, but it hasn't broken out above the prior highs from September. So I think it's just critical that we watch and see how the market behaves. This is a monthly chart. Obviously, we're at the highs here towards the end of the month, so everything looks good for Monday, and then we'll just see how things get handled on the Fed meeting. Okay, currencies were big. Lots of news there. So here's the US dollar pushing higher, and I'm just going to jump down to the last chart because it makes it a little cleaner. You can see this big push now. We got up to 97, 90, and then for a closing high on Thursday, and then Friday finished back below 97.75. To me, the line in the sand is at 97.50, and there's just so much history at 97.50, and I've covered that off multiple times, but this is the 97.50 line on this chart. And again, if we're going to start pushing higher with the US dollar, I think that puts pressure on the rest of the world. Just slows everything down because there are a lot of commodity countries over there, and they end up with their slower economy. So we'll see if that happens. Again, it's the world demand that I'm kind of looking at for clues, and we just don't see it. We aren't seeing the great stuff. So here's emerging markets, and it looked really nice a couple of weeks ago, starting to push above these prior highs. And then so far it's rolled back over. Now the real question is, can it hold this sort of trend line? And you can see the negative divergence on the momentum indicator there. So we had this trend line in place, and now it's being tested, but it's this kind of thing that we're worried about, where we've got higher highs and lower lows. So watch closely. I think if emerging markets start to shatter again, I don't think the US market will wait too long to follow if global growth starts to be impaired. Okay, so that was, we got there by starting on the currencies. Let me just add this chart. But on this US dollar, I think it's a pretty big deal, and I'm just going to show you the emerging market currency. CEW is the ETF, and you can just see, we're near 3-month lows on these. It is above the 200-day moving average, so that's somewhat bullish. I think the real problem is momentum is now dropping below zero again. So pretty important week for the US dollar. Is it going to hold above this 97.50 level? And if it does, I think that's an important place to be aware of a trend change. XEU, the weekly, so this is our euro, and you can see pushed down hard, closed in the bottom third of the bar, so not that bullish. PPO has rolled over well below zero after gently struggling to get higher. It hasn't been able to make anything really go. It's hard to imagine it's going to snap lower based on how kind of slowly it's evolved down. I think the bigger issue is, if this is getting weaker, it doesn't mean that it's bullish for Europe if their currency falls, but it can work that way for a period of time. Like you see here, the currency was falling, and so Germany went sideways for a while, and then right near the end took off on the uptrend, and then as the market started to stabilize in the euro, Germany started to fall through 2015. So I keep watching just to see which way this is going to go, but we have a lot of major trend lines we're trying to watch hold, and it's the Swedish krona that I like to look at to give me a clue on the euro, and it had an ugly week, finished right pretty much on the lows, and its uptrend in momentum is actually turning down and breaking. So to me, all of those things add up to probably lower levels for the euro, which might help the European zone, and we'll continue to see their charts break out to new highs. British pound, big 2-year uptrend here. We did put a new couple of month low in place today, or on Friday's close. The bigger issue is this 126, 127 level. If we come down here and start to break, I think that would be a big deal. You can see we got stalled at the 65-week moving average, and we're rolling over right at zero on the PPO. Histogram is marginally positive this week, but if this line crosses below its signal line, that would give us a negative histogram, and when it fails right at zero, that's an important place to watch. That's what happened back here, and it was a pretty big drop after that. So you do not want momentum rolling over at zero, especially after approaching from below. Okay, Japanese currency tight in this trend line here. We've got this 4-year level, and what we see is it had a big outside reversal bar. So last week was a doji after a big down week, or a wide-ranging week, and then this week we had a test lower, push higher, and a close in the top of the bar. To me, that's a buy signal to go higher with a tight stop. So as bad as that candle is in terms of price, it also held up at the 89 level, and I'll show you what that means on this other chart. So here's 89 on this black line, and just going back many years, you could just see that the euro, this 89 level, is very common for it to hover around. So I don't know if we're going to break through that, but if we do, it'll be one of the weakest levels, again pushing us probably back down to that 2015 low. And if it's going to start to break to the upside, which I think it does based on this candle, a push up in the yen would probably be the US dollar weakening compared to the yen getting stronger, but that would concern me a little bit. You can see the yen rose in 2007 and in 2015. As the market topped, the yen kind of bottomed and took off to the upside. So we don't have an answer yet on which direction this wants to go, but we continue to get narrower, so we'll just see which way this yen wants to break out. Canadian dollar didn't do much. Came down to test this low this week, bounced off it on Friday. It looks a little more bullish. I will say the PPO rolled over and gone negative again, but it's done that down here once before, and so this is our second time. We'll just see if we're going to continue to tread sideways. It doesn't give me the feeling that the Canadian economy is that strong, so I could see the Canadian currency starting to push lower. For the Aussie, this market, big downstroke in the currency, and you might remember the stock market took off to the upside, but this is trying to hold this kind of 3-4 year low level here. And if this is going to start to break again, if all of these charts are breaking against the US dollar, I think that sends the US dollar screaming higher. Okay, so we covered that off. The transports are an interesting one this week, and I'm just going to quickly show you here. So we broke out of this kind of range, pushed up, and then pulled back down, and now we're sitting right on the top of the range. I think this is an important area for us to hold, because it would be breaking through resistance, now becomes support, and we want to start to push higher off of that. We have a lot of negative divergence on the high, so that's somewhat uncomfortable to expect higher highs. Airlines sideways, nothing really to report there, and the railroads continued to have a good week. They pushed up big, and then they're still consolidating here, but 6 weeks sideways, but that's up near new highs, not a problem. And lastly, we have trucking, and this chart was trying to break out, continues to work it. Just zooming in here, you can see this is the 200, this is the 50, and it looks to me like they're going to, it straddled those two lines, but it was an inside bar from the day before. So not a lot of clarity on which way the truckers want to go, but they're basically hovering right near their moving averages. And with that, I want to thank you. The market outlook, I'd say the bonds are the big thing to watch this week with the Fed meeting.